Hey, 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 what is up? What's happening? All right, coming at you, coming at you. We got a hot topic for you here today. What to do if you owe a lot of money in taxes, right? And of course, I mean, if you agree with how the government uses your money and it uses it a lot better than you could, then certainly pay it. What's your problem? But if you think that giving the government more money may not be the answer, maybe we want to keep a little bit of that and give it to our favorite causes or our family or about anywhere that may make more sense, then I think this is the right webinar for you. So drop a comment. I mean, obviously, if you're on here, you want to learn. And I just want to, I want to very specifically, this is not, I'm not focused on tax saving tips. I'm like, I mean, there will be some in here, but I'm specifically talking with our guest today on what to do if you're already past that. All right, you've made money. You're like, oh no, let me reduce this big bill because I've seen what the government does with my money. All right, and I always like, Rand Paul. Every year he does a airing of grievances, and he labels out all the different ways that the government uses money in not their greatest ways, and it's hilarious and also sad at the same time. And so drop a comment if you look forward to learning how to keep some of your own money, the money that you earned. What's up, Romy? What's up, Imjoy? Aaliyah, is it? Out of Ontario. Very nice. Very nice. And hit that like button if you like this topic. I mean, if there's more interest in this topic, maybe we'll do a little bit more on how to save on taxes or what to do if you already owe a bunch in taxes. Let me know. I think I got maybe a little bit of a delay, or you guys are being very shy. Maybe you're worried that the 80,000 IRS agents are watching it. I don't know. Kimberly, Michael, pay your taxes. That's what Michael says. Michael says the government uses it in smart ways, so why learn anything that may have you keeping some of that money? I'm just kidding. I'm assuming, Michael, that that may not be your exact strategy. All right. So my guest here today, are you guys interested? Right? You do want to save some money in taxes, right? I mean, I think entrepreneurs and business owners, I think we can fund the right causes only a million times better than the government can. So that's just my take, right? That's just the way I roll. That's my thoughts, at least. All right. So at least 3 of you are interested. Perfect. That's all we need. We just need 3. Perfect. All right. So my guest today, he is a real estate investment veteran. So he'll talk a little bit about that. He's controlled over 325 million in real estate transactions. He's an author, entrepreneur, public speaker, coach. His company is Resilience Equity, and he basically rescues a lot of entrepreneurs and business owners and investors to how to keep some of their money, how to keep some of the money instead of just literally setting it on fire by sending it all to the government. But anyway, please help me welcome my man Mike from Resilience Equity. Mike, how are you today?
I'm great, Ray. I love that though about hiding from the government, right?
Yeah. We have fun on here. We have fun, and obviously, right? I'm not saying to duck your taxes, but if you can figure out ways to use it for your causes that and understand, versus I remember seeing they spent $88 million buying green camouflage uniforms for the troops in Afghanistan. Green. Yeah. That doesn't maybe make a whole lot of sense. I know they spent $300 million testing cocaine on ducks.
That's crazy. Those numbers are just not. Hey, listen, I heard somebody years ago who we both know really well, but somebody say, you might there's nothing wrong with paying taxes. It's just how much you're going to pay in taxes, right? because there's ways that you don't have to, that you can save on paying taxes. And I want to pay my taxes, right? I think everybody wants to pay their taxes because that's what keeps the government running. But
Sure.
should we pay, 50, 60% in taxes? No, I mean, there's ways to um, alleviate that for yourself.
Yeah. Yeah. Amen. So what do people do if it's already they've made a whole bunch of money, they whether anticipated, non-anticipated, they're looking at a big bill, for the IRS, and they want to keep some of that money. They want to multiply it. They want to fund a favorite cause or do something with it. What have you seen that has helped investors and helped entrepreneurs?
Well, I think there's a number of different ways. A couple things are, small home business, right? If you have a home business and you can take some deductions and take some write-offs, that's pretty straightforward, pretty easy way to do that. There's a lot of write-offs. You can make donations, and that's all tax deductible. But I like alternative investments, specifically real estate. But if you can go into an asset that's a depreciable asset and take the depreciation, and I always talk about this, Ray. I say that depreciation in real estate is one of the greatest gifts the government gives us, right? And if you look at it, the value in real estate goes up organically, but the government continues to depreciate it over time. They lessen the value of it. So there's a spread in between there, and you get to take dollar for dollar off of your taxes that spread. So, let's just say that you can be in a real estate opportunity, and you can't do this on your personal residence. It has to be an investment piece of real estate. So you can depreciate. There is depreciation on your personal residence, but it's not like the tax savings you get from investment real estate. So on the investment real estate side, whether you're an active investor doing, buying that, renting it, maybe it's short-term rentals or small apartments, or you're in a syndication, uh, passive investing, you can take dollar for dollar. So say somebody has $100,000 of income, and they're going to be taxed on that because they don't have good traditional, deductions. And let's say they get $20,000 worth of depreciation from a real estate asset that they're in. Now they can deduct that 20,000 dollar for dollar. So now instead of being taxed on 100,000, they're only going to be taxed on $80,000. So it lessens your taxable responsibility on your personal income.
So you like real, obviously you've done a lot of it. You like real estate as the best way to save on taxes.
Yeah, I think it is. I think it's the best way. And if you look at some of the wealthiest people in our country, that's where they make a lot of their money is in real estate. I mean, matter of fact, one of the statistics that I've heard recently is that 90% or the wealthiest people in this country own real estate, but 90% of that real estate is multifamily apartment real estate. So they don't own that and operate it themselves. They're invested passively. So they go to a sponsor or a syndicator, somebody who has an offering that they bring to the market, and that sponsor or syndicator raises private equity, and those people get to invest in that piece of real estate.
So maybe work us an example, right? So like you've made I mean, I guess your example, you've made 100 grand, for the year. And so that's your income, not mixing it up. That's your taxable income. So maybe you made 120 and you got 20,000 in write-offs, but your taxable income's $100,000, and you have a few choices, right? You could, write a $10,000 check, to a charity, right? That would reduce it to 90, right?
Right.
And that would be a good thing, right?
Right.
That would be, smart, like help your favorite cause, like awesome, like you're directing, the money, and not obviously not ruling that out. But if you took a chunk of money, because what I'm getting from what you're saying is that whatever you putting that into real estate, and let's say whatever it's, you put 50,000, just to use a different number, you put 50,000 into a real estate investment. Same thing that comes off of your 100,000. So now you're taxed at 50. Is that correct?
Correct.
But the
Correct.
difference is, like, you're putting it in something that's growing, right? That may even be cash flowing. And so like you're putting it into this, I get multiple things back from this, not just the reduction of taxable income. Is that
Right. Correct.
my
So
layman's way of explaining it?
yeah, so let's say you invest in a multifamily syndication. You're going to get cash flow along the way. You're also going to have equity in that deal for long-term appreciation. Plus, you get to take tax advantages. So if I bring a multifamily syndication to the market for investors to participate in, I might say, and here, let me just pre-qualify this because my attorney's going to say, did I say this? But I'm not an accountant and I'm not an attorney. This is all personal
Me
experience.
neither.
Yeah, this is all personal experience. So what we're not doing is we're not teaching anybody to avoid taxes. We're just teaching them how to play the real estate game with the IRS that is offered to us. So if you're in a multifamily syndication that, let's say, the projected return on it is 17.
For those that don't know, what's a multifamily syndication?
So what I do is I buy large apartment complexes in specific markets in the U.S., and we raise private capital from individual investors to come into those multifamily deals and partner with us and share in the returns. So somebody could invest in one of those multifamily opportunities and not have to take care of the day-to-day activities. And I always say you don't have to take care of tenants, trash, or toilets. Somebody else does all that.
Right.
And you participate in the returns. Typically, it's the lion's portion of the returns also. So we always tend to give more back to our passive investors, our private investors, because they take as much calculated risk as we do, if not a little bit more, by putting their principal or their capital investment into that. So let's say that return is projected to be 17% a year.
I'm curious, is the depreciation different if you are like managing the property and you're collecting the rent and all that stuff, or is it just based on how much you put into it, regardless of how you work it?
Right. It's not different. So it's the same. Oh. So on the,
that's awesome.
On our side, we get as much depreciation as on their side. It's based on the split of the, we pay our investors 70% of the returns. They get 70% of that depreciation as well. We take 30% for packaging those opportunities and bringing them to the market. Okay. So a typical investor that's going to make 17% a year on a return on an investment like that doesn't include depreciation. So you start to add depreciation into those returns for investors that are qualified to take that depreciation. They could be in the low 20% return on their investment. And so, we'll provide cash flow along the way. So on an annual basis, you might get 7%. So if somebody invests $100,000, they're going to get 7% a year, and the rest would come in equity at the back end. But along the way, they could still take the depreciation.
What would prevent them from taking depreciation?
So if an investor invests with cash money, cash that they just have in the bank, in a checking account, money market, whatever, they are allowed to take the depreciation. Some investors who invest through qualified funds, like a self-directed IRA or a self-directed retirement account, are allowed to take the deductions from depreciation in some cases, and that becomes an accounting question, real detailed. That's a conversation that investor has to have with their accountant about how best to structure that.
Yeah. Like if it's a qualified account or a Roth or something like that.
Correct. So,
Got it.
but your cash investors get the best opportunity, right? Not that somebody in a retirement account, in a Roth or traditional or a self-direct, a 401k can't get good benefits, because they can. If you look at what the stock market's paying today versus what this type of opportunity pays today, there's a lot more money in the alternative investment space.
Because a lot of people, they're looking because they're maybe nervous about stocks and nervous about inflation and everything. So they're looking for something that's more tried and true. People are going to rent, right? And with mortgages and the rates going as high as they are, I believe probably more people are going to rent.
So here's a phenomenon. There is a thing called cost segregation. So typical depreciation in a real estate asset, you would run that out over 39 years. So you would take a straight line depreciation over a 39-year period on a piece of real estate. But there's this thing called cost segregation, and really it's an engineering study. So what we do is we go hire a third-party company. They do this engineering study. And what we do with them is we say, hey, we're going to put this much in capital improvements into the property. And it's going to take us this long to inject that money in that opportunity. They do this study. And from the study, we get to do what's called bonus appreciation. So that bonus appreciation comes faster, sooner. So let's say that we're doing a property right now in Oklahoma, and it's a $19 million purchase, and we're going to go in and put $2.5 million in capital improvements into the property. The cost segregation study will look at all those numbers, and then they'll look at what are we putting in that property that's hard assets: roof, windows, air conditioning units, upgrades in lighting fixtures, things that are physical items that you can depreciate longer. So you can depreciate them over time. So instead of depreciating that out over 39 years, we take it in the first 3 to 5 years. So like year one in that opportunity, we're going to take $3.5 million depreciation, which means that it's a bonus depreciation. So investors that invest in that get to take it faster. And what it does is it will lessen your taxable income or your taxable responsibility. Got
it. Maria's asking, what's the ideal investment amount to make returns?
I think
that's a personal situation, right?
Yeah, I think it's a personal situation. It's dependent on what you earn, what you think you're going to earn next year. What was your tax consequence last year? I think every person is individual, and I don't know that that's really gonna, that there's a blanket answer for that.
Yeah, because there is. So when you do these, kind of deals, when you invest in a syndicate deal, there's a certain amount of time where that money is tied up, and that's in the project, and you're not able to, withdraw from it. It's not a savings account. How does that work?
So you come into a syndication, you become a member of an LLC. The LLC actually buys the real estate. So your initial capital's in the real estate, protected, by the real estate value. So that initial capital that you invest sits there, right? Your returns come back to you through how the deal structure is structured. So if somebody invests $100,000, That is part of that real estate asset. It sits there, their principal sits there, but they will receive 7% a year cash on cash return along the way based on their investment amount. And that typically gets paid out quarterly. So every quarter, somebody can walk to the mailbox and get a check. And then the promote is what we call it, which is the profit at the back end comes upon sale or exit or refinance, however we exit the property at that point.
Gotcha. And some of you, those of you in my real estate group, you may recognize Mike in that earlier, him and I, this was, I don't know, maybe a month ago or so. I don't know, maybe 2 months ago. I don't know how long it's been, but a couple months ago, we talked about a deal that we are actually working, together, and that's the Tulsa deal, which is a 200 unit deal. And I just wanted to make sure whether people get it on the deal or not, that they understand how this helps you with taxes. And then apparently there was just a Wall Street Journal article today, which you had mentioned, talking about the huge amusement park that's going in, not even an hour away from the deal that we're doing. So that's pretty cool timing.
Supposed to be bigger than Disneyland.
It looks humongous.
I know, right?
It looks crazy, but that's that's cool. That's going to bring more jobs. That's going to bring more income. I think this is really powerful timing here.
Hey, listen, I don't mean to cut you off, but Hector put a comment in the chat, in the comments, and he says he uses his house for business and uses 3 rooms in his house for business meetings and that. And he's asking, you can write that off. Can you depreciate it? I don't think so. But again, you got to ask your accountant. I don't think, because your personal residence, even if you're paying yourself rent for renting those rooms, it's deductible, but it's not depreciable. Remember, there's 2 sides there, right? Deductions, which are expenses, or depreciation. And this goes back to that cost segregation conversation, because really why you do cost segregation is because normally what you would do is just expense it. So if I went and bought a new light fixture, I could write it off as an expense and, against my income. But if I depreciate it, I can take it over the life value of that. Maybe a fan light in a living room, I can depreciate over 7 years, right? So I take a little bit. And when you start to multiply that out times 200, 300 apartment units, and the cost gets bigger, of course, you might not want to do it on a $49 light, but when you have 200 of them or 300 of them, now you have a larger influx of cash that now you can take over a longer period of time and use as a greater write-off.
Yeah. We, there are 2 things that might interest you though, Hector. And again, not an accountant, so get with your accountant. But at the event that I met Mike at in Chicago, where I was speaking at a real estate event, I heard 2 concepts. One was the Augusta rule, where I actually later learned it was called the Augusta rule, where you can rent your primary residence for up to 14 days tax-free. And the reason they call it the Augusta rule is people that live close to the Masters will head out of town around the time of the Masters and rent it for a ridiculous amount, all tax-free. That's pretty sweet, especially if you live close to some kind of attraction or something like that, the Indy 500, the Derby, whatever. The other thing is, and again, get with your accountant, but the other thing is you can, like, let's say you're going to have a meeting at your house, and like a lot of network marketers, follow our training and stuff. And I bet very few of them use this or even know about this, but you can go and price out hotel rooms, right? Hotel meeting rooms, and you come up with a few different prices, and you can average that. And actually, that's what you would charge yourself for that, and that's a write-off if you have it in
Wow.
your house.
Well, that's pretty cool. I didn't.
That's pretty wild. So if you're in a high-end district, right, and you're like, dang, I want to save money and have it at my house. I don't want to book the Hilton or whatever. You can go price all those things, get the average of, I think it's 3 to 5 different, places, and say, okay, I didn't hold it there, but I held it at my house. So I'm going to charge my LLC, whatever, $7,000 or whatever it is. That's 100%, write off. And then my friend, Michelle, who's a rock star, she says, and you have talked about this, but maybe you have some more to add. She says, typically in a syndicated deal, are you still getting the tax deductions?
Yes.
Yeah.
Yeah. So you're getting both. There's deductions that we take. So you're going to deduct paint, but you're going to expense. So it's a capital expense for hard assets, air conditioning, lighting, windows, things like that. But paint, you're going to expense, or a furnace filter, you're going to expense, right? So.
Yeah. And a lease adds, but you have to count the income on your personal, right? I mean, I guess that's how you take the income, right? Or how is that? How does that work?
Yes. So great question, Elise. At the end of the year, you get what's called a K1. K1 is a passive investment tax reporting form. And what it shows is it shows any income that you would have, but it also shows all the expenses and losses as well as the depreciation. So that's a tax document you'll give to your accountant when you do your taxes at the end of the year, to write it off on, I believe, your Schedule E on a tax form.
Yeah. Yeah. Looks like she answered it as well.
Yeah. Oh, she got it. Yeah.
So
good
cool.
guess on my part.
So cool. So 2 quick things. Number one, most of because we've been talking about it nonstop. We have our event in September in Orlando. John Maxwell is our keynote speaker. Amazing. And Mike is going to be there. So if you'd like to come and meet Mike, come and meet him. Just a wealth of knowledge, and he has an incredible faith story. And so, the event is Faith Over Fear, and it's just going to be awesome. So, come along and meet him. And then number 2, like I mentioned before, and there's actually more details in the real estate group. Mike and I are working together on a deal in Tulsa. It's a 200 plus unit in Tulsa. I think it has a lot of upside, and it's, again, right around an hour from that humongous $2.5 billion amusement park that's going in. And we just think it's really incredible. So if you'd like to learn more about that, feel free to shoot me a message, and I'm happy to connect you. We did have 2 more, questions come in here. Delyn says, what's the minimum amount? I mean, that's going to vary, but I think I believe on the Tulsa deal, it's 50,000, I believe.
Yeah. The Tulsa deal, it's 50,000.
You need to be an accredited investor. And so maybe you can explain that too.
Yeah. So accredited investor means that you qualify one of 2 ways. One is that you have a net worth of $1 million, excluding your personal residence, or you've earned $200,000 the last 2 years. So if you fall into either one of those categories, you're an accredited investor. What I see in the marketplace and what we bring out for an accredited investment, that minimum investment will typically be $50,000 starting. And then there's always a maximum in a deal that you can't put more than in, because then you own so much percentage of it, you'd have to be on the loan, and that takes away from the passivity of it. I do see non-accredited investments out there where people can get involved for $25,000.
Sure. And then Stephanie asks, basically, well, you can probably see her question. Yeah. I'll let you break that down.
Yeah, great question, Stephanie. You don't need your own LLC. If you're investing cash, you're gonna sign as a member of the LLC that's created that holds the real estate. Now, In some cases, people do have an LLC. They take their business and their business becomes the managing member in the parent LLC that holds the real estate. If you are investing through a self-directed IRA or a retirement vehicle, qualified funds vehicle, they typically have you structure an LLC, but it's all part of that process. So it's very simple, and you don't have to go out and create a brand new LLC to do it. So hope that answers that question.
Yeah. And Michelle asks, can you 1031 into a syndicated deal? It has to be like kind, right?
Yeah. You can 1031 into a syndicated deal. Now, you can't into ours because there's a certain structure. It's called, you have to create what's called a DST, a Delaware Statutory Trust, or a TIC, a tenants in common structure. We don't have that set up in ours. But there are opportunities out there you could get involved with that, are those structures that'll take 1031. And I think that, on the next one we do after this, we will have a 1031 structure. With 1031, it's a timing thing. So
yeah, because if the deal doesn't, if it's a big old deal and the deal doesn't close on time, you
blow your boot is what they call it. So
blow your boot.
Yeah.
That sounds terrible.
The boot is the transfer. It's the funds transfer. And,
gotcha.
If you miss your timing,
sure.
Now you've got this tax consequence. But here's what I tell people too. Look, if you have a tax consequence that's coming from a trade, but you go into something else, look at both sides of it. Because even if you miss your window, and there was, I can't remember the number. It was upwards of $700 million last year in missed windows with 1031s. Wow. I mean, it was a big number in 2022 that people missed that opportunity. But, the offset could be, you're
not that big. Like, hey, I missed it, but I still moved my money into real estate. So it may not be that much of a punch in the face.
Yep.
Got it. Very cool. Very cool. Well, awesome. Well, this was very informative. Drop a 1 if you got some value from this. Now a few things that probably a lot of people don't know. And so, let me know if you'd like to come meet Mike. Come meet him in Orlando. If you want to connect with him sooner, shoot me a message. I'm happy to connect you. And if you are wanting more details on that Tulsa deal that we are working together along with some other partners, we do have that in the real estate group. And so just, let us know if you'd like more information. Be happy to share it with you.
Awesome. Thanks,
Mike, any last words?
No, I appreciate you having me on. I'm looking forward to September. Looking forward to some people participating with us in this syndication also. Yeah. So if I can answer questions for anybody, reach out. And, if I can be of help or even just knowledge wise, I'd love to do that. So
for sure, man, for sure. Well, thank you, Mike. Mike with Reliance Equity, amazing, or Resilience Equity, sorry. And just really appreciate you, brother, and look forward to our chats always.
Thanks.
All right. Bye, guys. Appreciate you.